Welcome to This Explainer. I am so pumped to have you here today. Listen, if you've just started earning, or maybe you've been working for a bit, but your bank account, well, it isn't really reflecting all your hard work, you are in exactly the right place. Think of me as your elder brother today. I'm here to demystify wealth creation for you, step by step. We're going to cut right through the noise, drop the complicated Wall Street jargon, and build a completely no-bluff, highly practical roadmap to get you from totally confused to absolutely financially stable. Okay, let's dive into this. Here is our exact blueprint for today. We'll start with the beginner's dilemma, talk about building your foundation, walk through some simple steps to wealth, look at leveling up your game, avoiding common mistakes, and finally, we'll map out your ultimate investing roadmap. No fluff at all, just actionable steps.
All right, part one, the beginner's dilemma.
We all know the feeling, right? When that very first paycheck hits, you feel like a king. But then, the month ends, the money is somehow gone, and you're left staring at the ceiling asking the ultimate question, where should beginners actually invest first? Honestly, it's incredibly overwhelming. You open up social media and one finance bro is aggressively pushing real estate, another is flashing chaotic crypto charts, and your friends are bragging about day trading. It just fuels this massive, almost paralyzing fear of missing out. Because of that crazy overwhelm, beginners usually fall into one of two pretty dangerous extremes. On one side, you've got a paralysis, just leaving your money to quietly rot in a standard savings account where inflation literally eats it alive. On the other side, the gambling mindset, just jumping straight into super risky stocks out of pure FOMO. Both of these are going to keep you broke. But don't worry, there's a much smarter, structured middle path. Moving right along to part two, foundation before investing. Look, you absolutely cannot build the heavy roof of wealth before you pour a rock-solid concrete foundation. It just doesn't work. Investing works best when your financial foundation is totally stable. Before you even think about buying a single stock, you've got to master the boring but honestly beautiful basics. That means budgeting, controlling your daily expenses, and ruthlessly avoiding bad consumer debt. Seriously, stop financing phones you can't afford just to impress people you don't even really like. And that stability? It starts with this magic number right here, 3 to 6 months. This is exactly how big your emergency fund needs to be. Just calculate your bare minimum monthly living expenses and multiply it by 3 to 6. You want to keep this cash in a highly accessible liquid account. Why? Because life happens. When your car suddenly breaks down or a random layoff hits, this fund is the safety net that prevents you from panic selling your long-term investments or getting sucked into a terrible high-interest credit card trap.
Now, what's really interesting about this is we need to completely reframe how we view health insurance. Way too many young, healthy folks just ignore it. But listen to me, it is a mandatory financial shield, not an investment that's supposed to give you a return. With medical inflation skyrocketing globally at double digits, literally one unexpected trip to the hospital can wipe out 5 years of your hard-earned savings in 5 days. So buy health insurance immediately. You're protecting your wealth.
Okay, part 3, simple steps to wealth. Now that your defensive shields are locked in and doing their job, it is time to go on the offensive. Meet your new best friend, index funds. Instead of trying to guess which single stock is going to be the next big winner, which, let's be real, is basically gambling for beginners, index funds let you buy a whole basket of top companies all at once. If you pair this with a systematic investment plan or an SIP, you invest a set amount automatically every single month. Boom, you've just unlocked the unbelievable power of compounding, and you didn't even need to be a Wall Street expert to do it. But I need you to really hear this quote. Most beginners don't lose money because markets fall. They lose money because they panic emotionally. The stock market goes up, and yep, it goes down. That is perfectly 100% normal. But as your elder brother here, I am warning you right now. When the market dips, your emotional brain is going to scream at you to sell everything. Don't do it. True investors stay patient. They stick to their SIPs right through the volatility. Let's dive into part 4, leveling up your game. Okay, so once your automated investments are just humming along on autopilot, you might be feeling ready to take some calculated risks. But hear me out. If you want to buy direct stocks, you absolutely cannot do it based on a random YouTube comment or some hype on social media. You have to learn the business fundamentals first. We're talking revenue, profit, debt, return on equity, cash flow, and valuation basics. If you don't understand these terms, you aren't actually investing. You're just gambling in a suit. But honestly, the absolute most powerful investment at this stage, it isn't a stock at all. Your income growth often depends way more on your skills than whatever your initial salary was. Especially in your 20s, investing in yourself literally yields the highest ROI on the planet. Spend some money to learn high-income skills, master new AI tools, improve your public speaking and communication, or learn how to code. Actively expanding your capacity to earn, that is the ultimate wealth hack. And this brilliantly illustrates how a mature investor actually thinks about the whole shebang. Different asset classes serve entirely different goals. It's like a giant puzzle. Gold, that's for safety and diversification. Things like PPF and EPF, they offer steady, long-term safety. Debt funds give you stability and liquidity. And real estate provides growth and a physical, tangible asset. See, there's no single perfect investment. You balance them out based on your age, your specific goals, and your personal appetite for risk.
All right, part 5, avoiding common money mistakes.
In the world of finance, knowing what not to do is literally just as critical as knowing what to do. I mean it. One massive mistake can easily set you back a whole decade, so pay close attention to these beginner traps. Do not blindly follow influencers who are pushing sketchy penny stocks. Stop chasing quick money. Real wealth is a marathon, not a sprint. Never, ever invest before your emergency fund is fully topped up. Otherwise, you're just begging to be forced into panic selling later. And please, stop taking excessive risks. Remember, the house always wins in the end. Let's just recenter our entire philosophy around this single powerful idea. The goal is not to become rich overnight. The goal is to build freedom, security, and true peace of mind. True wealth is surprisingly quiet. It's the feeling of knowing you can easily handle an emergency without breaking a sweat. It's knowing you don't have to stay stuck in a toxic job just to pay the bills. That quiet security is vastly superior to the loud, flashy, totally stress-filled fake wealth you constantly see on social media. Finally, part 6, the ultimate investing roadmap. All right, we've covered the mindset, we've spotted the traps, and we've geared up with the right tools. Now it's time to bring every single piece together into your master plan. I highly recommend you grab a screenshot of this right now. Step 1, control those expenses. Step 2, build that emergency fund. Step 3, buy your health insurance. Step 4, start consistent SIPs into index funds. Step 5, only after all that, start learning the stock market slowly. Step 6, improve your earning skills. Step 7, diversify your assets. And Step 8, always think long-term. As we wrap up this explainer, I want you to really internalize this truth. Your future wealth is going to depend way less on blind luck and so much more on the habits and the decisions you consistently make with your money. Compounding doesn't care about how naturally smart you are, it cares about how incredibly disciplined you are and how much time you're willing to give it. Time and discipline, my friends, those are the ultimate cheat codes for financial freedom. So, I'm going to leave you with this somewhat provocative question. Are you going to start building your unshakable financial foundation today, or will you keep waiting on the sidelines for some magical, perfect stock that frankly doesn't exist? The clock is ticking on your compounding potential. Don't let analysis paralysis cost you your future freedom. Get out there and take action. Thank you so much for hanging out with me for this explainer, and I will catch you in the next one.